Ever heard the term stock split and wondered why in the world any company would willingly and intentionally make the price of their stock cost less? Or maybe you've heard about companies buying back their own stock and wondered, what does that even really mean for you as an investor? Today, I'm going to demystify all of that. I'm going to teach you what stock splits are and show you how they can make you some serious extra cash. I'm also going to clarify the difference between a reverse stock split and a stock buyback, because they are two totally different things and they generally signal two totally different situations going on within that company, and you need to know what's going on so you can make sure you don't fumble your bag. And stay tuned for the whole episode, because today I'm going to show you how you could have taken $2,200 and flipped that into over $17 million as a real life example of what some people have actually done, and you could have done it. I'm going to teach you how stock splits can make that happen.
We getting money, money, money. When Jameer sharing gems with her getting money, money, money. Getting a line, growing money and getting money, money, money. It's your life, trying to give more life. Getting money.
Don't forget to like, comment, and subscribe if you have not already, and hit the bell for notifications so you never ever miss any one of the episodes that I'm dropping, because I be dropping them gems. Oh, and I have a gift for you. I have a list of 26 monthly dividend paying companies that you can download for 100% free. All you gotta do is click the link in my show notes to go and grab it. All right, so what exactly is a stock split? In the simplest terms, a stock split is when a company increases its number of shares while maintaining the same overall value. It's like slicing a pizza into more slices. The pizza is still the same size, but there's just more to go around. Here's one example. Let's say you have a company that has one share priced at $500 per share, but then that company does what's called a 10-to-1 split, meaning they split that $500 10 ways. So after the 10-to-1 split, you would have 10 shares valued at $50 each. So in this example, if you owned one share worth $500 and that company did that 10-to-1 split, you now own 10 shares worth $50 each. Notice how both values are still $500? That's the magic of a stock split. You now own more shares, but you didn't lose any value. So you may say, Gwen, that's all well and good, but why are they giving me more shares? What's the catch? Well, first of all, let's talk about why companies even offer stock in the first place. Companies offer stock to investors like you and I for one reason and one reason alone, and that is cash flow. Every time you, I, or anybody else invests in a company, we are providing them with capital to do a number of things. Hire more people, expand their business, buy other companies, do research and development on new products and services. The list for reasons as to what they'll use this money for is endless. But at the end of the day, their goal is to raise as much money from as many people as possible. So if the stock price is exorbitantly high, the chances of a lot of people being able to afford it is pretty low. Think about it. Are you more likely to buy a stock that's $3,500 per share? Or are you more likely to buy a stock that's $70 per share? Probably the $70 one. And if you pick that one, you be in good company, because 99.9% of people are going to pick the same option. Well, that's exactly what happened with Chipotle in 2024 when they did their 50-to-1 stock split. And I'll explain that in more detail in just a moment, so stay tuned. So if a stock price is $3,500 a share, that means way less people are going to be able to afford it, and therefore that means way less people are going to be pouring money into that company. So when the stock price for a company gets really high like that, a company might choose to split the stock, thereby making it more affordable for more people. Because again, the more people that can invest in the company, the better off they are. Also, they do it for liquidity purposes. When a stock is split, like in Chipotle's case, 50-to-1, that means that for every one share that was originally out in the market, 50 shares now become available. So let's say for round number purposes, Chipotle had 1 million shares of their stock on the market. When the stock split, they went from 1 million shares to 50 million shares. That's a lot more shares for people to be able to purchase and invest into Chipotle. Another example of a stock split is NVIDIA when they did their 10-to-1 stock split in 2024. At that time, their stock was trading at around $1,150 per share. So if you owned one share at $11.50, you suddenly had 10 shares valued at $115 each. Why did NVIDIA do this? Because they were on fire. But their price had gotten so high that it was intimidating for the average investor. They split their stock to make it more attractive to investors and therefore more accessible for more people to be able to invest in the company so they can continue to grow. So here's the $1 million question. Is it better to buy before or after a stock split? It depends on your strategy, but here's my suggestion. If you believe in the company, buy before the split. But that doesn't mean that if you don't have the funds to be able to afford a whole share of the company at its highest price, that you shouldn't buy after the split. It's just that buying before the split can set you up in a major way. Hang tight, because I'm still going to give you that example of how you could have flipped $2,200 into $17 million just in stock splits. But first, let me give you some pros and cons of buying before or after a stock split. If you buy before the split, the pros are that you might benefit from the pre-split hype and rising price as excitement builds for the stock split. So once a company announces a stock split, people get really, really excited. A lot of people are trying to get into the stock before the price splits because they want those extra shares once the split happens. So if you buy before the split, once the split occurs, you'll own your shares times however many times the stock split. So if there's a 20-to-1 stock split and you own 1 share, you will now own 20 shares. If you own 100 shares, you will now own 2,000 shares. 100 shares times 20 is 2,000. Now the con is that the stock could dip right after the split as some investors cash out. As far as buying after the split, the pro is that you get to get in at a much lower price, making it more affordable for you and allowing you to potentially buy more shares than you could have afforded previously. The con is that you're going to miss out on all those additional free shares. So here's what you've been waiting for. This is a very real life example of what many people did in order to take $2,200 and turn it into $17 million just through stock splits. This is when buying before the split could have worked really, really well in your favor. Chipotle IPO'd in 2006 at $22 per share. And let's say at that time that you purchased 100 shares at $22 a piece for a total cost of $2,200. By 2024, the price of Chipotle had run up to $3,427 per share. That means you would have gained a 15,477% return on your initial investment of $2,200. So that means that from 2006 to 2024, your $2,200 investment would have turned into $342,750. Wow! That's huge. Now keep in mind, during that whole time, you didn't put in a single extra dime. You just let that $2,200 sit there. You let it ride. You just rode the waves of everything. And it turned from $2,200 to almost $350,000. That is a serious come up. But we're not done. In 2024, Chipotle did a 50-to-1 stock split, meaning that for every 1 share you owned after the split, you would now own 50 shares. So your 100 shares would have turned into 5,000 shares. See how that works? When it split, the price went from $3,427.50 to about $68.55. But remember, the value of your investment didn't change at all. 100 shares times $3,427 is $342,700. Similarly, 5,000 shares times $68.55 is still $342,700. But let's say that after the split, the price over time again rose from around $69 to $3,427 again. But this time you've got 5,000 shares instead of 100. That means that if it were to reach $3,427 again, and it did it once, so it might be able to do it again, right? You now have $17,137,500. Here's the math on that. 5,000 shares times $3,427 equals $17,137,500. And all of that started with just $2,200. And keep in mind, you have not added a single red cent to that $2,200. That's a $778,877% return. Try asking any bank anywhere in the world to give you that kind of interest. It ain't gonna happen. Caveat for a second. This is why I am so steadfast on trying to teach you that you do not need to be afraid of the stock market. Please don't be afraid. These kinds of gains happen every day for other people. There's no reason why it can't happen for you too. To go from $2,200 to $17 million is insane, especially because it was completely passive. Not a single ounce of your sweat, not a single move of your muscle, no physical labor, no brain waves have been used. Like nothing is being used. You've been sleeping, you've been chilling, you've been living your life. You went from $2,200 to $17 million in less than 20 years. Keep in mind, that's crazy. There's not a single word that I can use to describe how mind-blowing and how life-changing that is for someone who was able to do this. I wish I knew then what I know now. I wish I know then what I know, but I know it now. I know it now, and I'm teaching it to you. In 2006, I ain't know none of this. None of it. I ain't gonna lie. I ain't know none of it. But I learned it, I taught it to myself, and now I'm teaching it to you so you can benefit from the same things. Now that I've calmed down, let's get back into it. So this is a very real life example of how stock splits can work in your favor, especially if you buy before the split. Okay, so now let's talk about reverse stock splits, because I don't want you to be confused about the two. I want you to know when to buy, when not to buy, what to stay away from, and what to run toward, okay? A reverse stock split is exactly the opposite of what we just talked about. It's when a company reduces the number of shares on the stock market, but increases the share price proportionally. So where a regular stock split might look like 10-to-1, for every 1 share you own, you're getting 10 shares. A reverse stock split would be flipped. It would be 1-to-10, meaning that for every 10 shares you own, you would now only own 1. For example, if you had 10 shares valued at $10 each, you would own $100 of that company. But if they do a 1-to-10 reverse stock split, you would now just have 1 share valued at $100. Again, same total value, but fewer shares at a higher price. So we already know why companies do stock splits. Let's talk about why they do reverse stock splits. They don't just do these things for fun. Companies that do reverse stock splits are usually doing them to avoid being delisted from the major stock exchanges, like New York Stock Exchange and NASDAQ, because both of these exchanges have minimum price requirements. And if a company's stock price isn't hitting that minimum price, they are at risk for being kicked off of the stock market. So for that reason, a reverse stock split is often seen as a red flag, because it suggests that the price of the stock is dangerously low. Both NASDAQ and the New York Stock Exchange have a minimum price requirement of $4 per share in order for that company to remain listed on their exchanges. So if a price of a stock starts to get close to that or drops below that, a reverse stock split is probably on the way. Remember, these companies want to remain on the stock market, so they can essentially continue to fundraise from investors like me and you. If they get delisted, they're no longer allowed to sell on the stock market, and that significantly limits their ability to have ongoing cash flow. So to prevent that, they might implement a reverse stock split. Here's a couple real life examples. General Electric, or GE, did a reverse stock split in 2021. It was a 1-for-8 reverse stock split. Their stock had dropped and was trading around $13 a share, but that reverse stock split bumped the price up to over $100 per share. GE did this to make the stock look more respectable and to avoid the stigma of a low price stock. Another example is Citigroup. Citigroup did a 1-to-10 reverse stock split back in 2011, and they turned a $4.50 stock into a $45 stock. This was all about maintaining institutional investor confidence from the aftermath of the 2008 financial crisis. Now, at the time I'm making this episode, ANGI, ticker symbol ANGI, is trading at less than $2 a share. That is dangerously low. And their board recently approved a 1-to-10 reverse stock split in order to boost the share price and to avoid them being delisted. Bottom line is that reverse stock splits usually occur when companies are in danger, whereas regular stock splits tend to occur when a company is doing really, really well. Okay, last but not least, stock buybacks. This is when a company buys back its own shares from investors. Why? Because fewer shares on the market means that each remaining share becomes far more valuable. Here's how it works. When there's a stock buyback, fewer shares become available, which naturally creates a higher earnings per share ratio. And because the earnings per share increase, it signals a financially healthy company, and that makes more people want to buy it. So the stock price normally ends up going up because of the increased demand from people wanting to get in on this healthy company and the reduced supply of less shares being available. Time for a real life example. Apple, they are the king of buybacks. In 2023 alone, they bought back $90 billion of their shares. And why would they do this? Because they were swimming in cash, and they wanted to reward their current shareholders at that time by boosting the stock price. We've already talked about Chipotle with their stock split, but Chipotle also loves to buy back their stocks consistently. This reduces the number of shares on the market, and it boosts the value of each remaining share. It's their way of saying we believe in our company and we believe in the company's future. This is also part of the reason why the stock price for Chipotle went all the way from $22 a share to over time hitting over $3,400 a share. So if you were a Chipotle investor at the beginning, you would have not only have benefited from the stock split in 2024, but you would have also benefited over time from all those stock buybacks that they do. Now, when it comes to buybacks, as an investor, you are never forced to sell your shares back. Instead, you've got a couple options. You can either hold your shares and continue to be a shareholder in the company, or you can sell your shares if you find their offer attractive. Now, let me clear something up that's oftentimes confusing. A buyback and a reverse stock split are not the same thing. A buyback is when a company is voluntarily buying its own stock from its investors, reducing the number of shares that's available and boosting the stock price. Companies tend to do this when they have extra money sitting around, because you can't buy something back if you don't have any cash, right? So if they got extra cash laying around, they will do this in order to reward current shareholders and boost that stock price without having to pay it out in dividends. See how that works? It's all coming together now, right? Now, on the opposite side, a reverse stock split is way different. During a reverse stock split, a company is combining multiple shares into one. one, increasing the stock price, but not changing the total value of the company. Whereas with a buyback, the total value of the company does increase. Again, companies tend to do reverse stock splits when their stock price has fallen too low and they want to avoid getting kicked off of the stock exchanges. Biggest difference, a stock buyback is a company showing strength, while a reverse stock split is often a sign of weakness. If a company is doing a buyback, they think that their stock is actually worth more. If they're doing a reverse stock split, they're trying to keep their stock alive. See the difference? Okay, here's the bottom line and here's what you need to know. A stock split is usually great news. A reverse stock split is usually a red flag. And a stock buyback is also really great news. You are now armed with the knowledge to navigate stock splits, reverse stock splits, and stock buybacks. So when you hear these words in the news or on social media, now you know what they mean. And you know what to do when it comes to your money. Don't forget to like, comment, and please subscribe to this show. And hit the bell for notifications so you are always made aware of when I drop a new episode with tons of gems to get you to 7 figures and beyond. I have a free gift for you. Go ahead and download my free list of 26 monthly dividend paying stocks. And if you want to take it a step further and really get to the bag, you've got to join me and the rest of my rich friends. I've got the link for you in the show notes that you can click on and get all the details. Thanks for watching. Until next time, peace.